This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. Today, we are very pleased to welcome on Casey Gregersen, CEO and founder of Bighorn Capital. And today, we're going to be discussing a topic that we really haven't broached too much on this podcast. We've alluded to it, had a few different guests, we've kind of danced around the energy sector. But today, we're really going to be kind of digging in to how real estate and oil and gas and energy production can be intertwined and really make an interesting fit for someone's portfolio, and also why you should really kind of be looking at this stuff. There's a myriad of different benefits that can be drawn, especially from the oil and gas sector, or just the energy sector in general, that maybe a lot of people aren't necessarily cognizant of. There's definitely some things to dig into that we all hear about, investing in oil and gas, and, people often think, oh, I'll just buy some Exxon stock, or I'll buy some Shell or BP. But when it comes down to it, with the alternative lens of really getting invested in these things, there's a lot of different options and a lot of different benefits. So again, Casey, really appreciate you taking some time out of your day to come on and talk to us about this very fascinating topic. I know I really enjoyed digging into it. If you wouldn't mind, give us a little bit of background about yourself and kind of how you kind of matriculated up to being in your current position as CEO and founder of Bighorn Capital.
You bet. Yeah. So thanks a lot, Alex. Excited. I love working. Over the years, I've worked a lot of self-directed IRA folks, and I think it's just such a cool opportunity. So we're very, very thankful for what you're doing. So my background is I have a degree in petroleum engineering, and I graduated in 2010 from the University of Wyoming, and I grew up there. So when people always ask, like today, I'm investing. Actually, when we close this next deal in the next 2 weeks, we'll have 400 units total that we own across our portfolio. But the majority of those, I would say all but like 300, I would say all but like 5 to 10 of them are in Wyoming. So I kind of fast forwarded a little bit, but that's why I grew up in Wyoming. But in 2010, so went to grad school, finished in petroleum engineering. I got my first full-time W-2 job at Shell in 2000. I actually interned there in 2011. In 2012, I started full-time. And I actually worked there for a solid 11 years. I actually just left 2.5 years ago. And so I was doing that, working in oil and gas, working as like a drilling engineer out on I would actually be like the foreman out on like a drilling rig. So people seeing like Landman, it's actually a really good depiction of West Texas. That was literally my life for 2 weeks. And then on 2 weeks I'd have off. And so during those 2 weeks off, I started flipping properties, buying rentals, and fast forward, that's where we are today.
Awesome. Great. So, when it kind of came to that transitionary period, because one thing I always like to kind of explore with our guests is, their jump into real estate, because rarely does anyone come out of maybe their more, traditional academic careers and be like, I'm going to be a real estate investor. While some do, it's typically not the case. It's normally kind of a second wind, or the second act of their investing career or their trajectory. And, coming from the oil and gas space, especially with getting your degree in petroleum engineering from Wyoming, like, what was really kind of that catalyst that said, hey, look, obviously you can make great money in oil and gas, right? But, what was kind of the point that you were like, hey, like, here's what I'm seeing out there, and here's why I want to make the transition away from what I assume was probably a pretty solid career that you had going, in the energy sector?
Yeah, it was a combination of a couple dominoes falling. I think the first one was I bought my first rental property while I was going to school in Laramie, Wyoming in 2010. Right, so I kept that property, and I actually didn't buy a second one until about 2014. But my second one, I actually did a refinance on the first one, pulled out $50,000, went and bought another one with that money. That was my down payment. Bought a second one, and I created one that was all said and done, and finished this because I bought it, fixed it up, rented it out. When it was all said and done, it was generating $1,000 a month of cash flow. And I was like, that was one big light bulb moment. I'm like, holy cow, I just generated $1,000. What was pretty passive, right? I mean, I was managing it myself, but I kind of had built a good system. And I'm like, man, how do I do more of this? So that was kind of the first one. And the second was actually in 2015, me and my wife opened our first franchise. It was a Pure Bar franchise in Midland, Texas, and gotta go do that. And we ended up, at one point, we had 7 of these Pure Bar franchises from Houston all the way out to San Diego. But what I was learning was I was getting to run a business I was getting able to make decisions. And I think my big thing was like, I was working for a big corporate company like Shell that has an incredible amount of red tape. There was to get things done and actually make decisions that would impact the company. And in a big way, it was so hard to do. And I was living two lives. I always tell people, I was like, I would work my Shell life where very conservative, slow moving, lots of red tape. And then I was able to be an entrepreneur where I could move quick, and I was incentivized to work quick and do deals and make decisions and be more aggressive. So when I started to compare those two, I just really found my identity. I'm like, I love being an entrepreneur. I love being able to impact how much I'm going to make versus this other company where I could be really safe and have a good pension and work in oil and gas, like you said, for a long time. But I just realized that wasn't what excited me, and it really wasn't going to be my path.
Yeah, no. So kind of going from there, making that transition, seeing the writing on the wall of just kind of the, the cash flows that you can make, because that's, really the main, kind of focus, at least with my own personal investing. And again, what I focus a lot on with my clients is that cash flow aspect. It's all great, well and good. Appreciation should really be the icing on what you're building, but cash flow, really being, the core focus is what's going to keep you afloat. Right. Because, with investing for, looking at that cash flow lens, it gives you the ability to invest, not completely price point agnostic, but enough to where, the underlying, value can, really be a little bit of a, lesser degree of, what you're looking at as opposed to, what you're actually making on it. Because, a $200,000 asset that cash flows $2,000 a month net cash flow. Well, if it's worth 100 and it's still cash flowing $2,000 a month, well, what does it really matter, right? And then when underlying values go up, the cash flows typically tend to rise, but the correlation between the drop in a cash flow and the underlying value, especially in real estate, really isn't as pronounced as you might see in the traditional securities world. So, especially with regard to real estate, that's one thing I really enjoy about it, and I think I would wager to guess almost any real estate investor that invests for cash flow also tends to agree with me. I won't put words into anyone's mouth per se, but again, that's really kind of a common core thread between a lot of people and why they get into real estate. So, focusing a little bit more on that transition, getting out. What are some of kind of really the first kind of things that you did to kind of build this portfolio, and what was really your initial kind of investment thesis that you had when, again, transitioning out of corporate into going into, founding Bighorn? What was kind of that initial, investment thesis, and has that changed over time?
Yeah, it's definitely evolved, but at the core, I think Alex, it hits exactly what you're saying. Like I've always invested for cash flow, and so as my career kind of went on, I was working in different. I lived in West Texas. I lived in Midland. I lived in Fort Worth. We were even in Montana for a while, but I ended up settling back in Houston about 5 years ago. So I'm in a market that's a really hot market for real estate, and a lot of people are like, "Why are you not investing in? You live in Houston. That's one of the hottest markets in the country." I'm like, "Not for cash flow, right? And especially today, because it has high taxes, high insurance. Like I love fix and flipping there, but what I found is in Wyoming, I could get good cash flow. And where I really realized this was, it was like, man, it's been almost 6 years ago now. I had a small portfolio in Dallas Fort Worth, and I had my portfolio in Wyoming, and I looked at the cash flow side by side, and I'm like, this stuff in Fort Worth, it's appreciating, right? But it's basically breaking even by the time and if I were not managing it myself, it would be breaking even, right?
Yep.
But my other stuff in Wyoming was throwing off all this cash flow. So I'm like, you know what? Let's sell it. So I sold that stuff, 1031 it into Wyoming, and about like a 14 unit and another fourplex. And now all of a sudden I was making like 5,000 a month in cash flow from these. So I just kept doubling down on that. And then I just realized that, okay, I had good cash flow. And then they're just the biggest thing. I mean, there's a lot of variables and factors I like in Wyoming and even the surrounding states, but I think the biggest, it's supply and demand, right? There's not enough houses up there, and a lot of it's due to construction and contractors. There's not enough people building, but there's still a lot of demand. So I just started doubling down and leaning into that, to where now we have our own construction crews, we find our own deals, and we're able to create a lot of the product. And I don't know, it's our competitive advantage, right? Because we can find the deals, fix them up, and then there's just a ton of competition for it.
All right, great. So a couple things that I think are interesting to dig into there is that, market identification, right? So again, to your point, as much time as I've spent in Houston, I have no particular love for the city, not left, right, or center. But I think, you really hit it on the head, especially with what we experience here in Florida is, again, depending on where you're at, but, there's a lot of kind of investment overhead that's seen, in our areas. One, price point, everything's, inflated. Two, cost of ownership, right? Everything's more expensive, especially in places like Houston or where we're at in Florida. Insurance, hurricanes, flood mitigation, all that kind of stuff. Can make, an otherwise deal that, let's say it was farther inland pencil pretty well. If it was in hill country in Austin, you don't have to worry about a lot of that kind of stuff. But, trying to pencil a deal that really works out from a cash flow metric can be tough in those
Hmm.
markets. So where do you look from there? Well, if you have to look at secondary or tertiary markets, that's where you can maybe find the value, but you have other things that are going to kind of play against you. Now, again, to your specific example, what I'd like to dig into a little bit is, I know from at least just, high level, I know Wyoming is, I think, the third or fourth least populated state in the nation. So, especially from the context of, if you're telling me, hey, I'm going from Houston to invest in Wyoming, I'm definitely scratching my head a little bit. It's, people, you build houses where there's people located, right? And with, a proportionally, just, the facts are the facts, a small population state like Wyoming, where do you kind of really find the ability to serve that market, and how did you kind of come to understand? Was it just by having lived there and obviously went to school and things like that there? But again, just on face value, someone says, hey, I'm going from Houston to invest in Wyoming. I'm really curious to know, what specifically, like, how you're serving that market to a degree that, you can actually make money there.
You bet. It's to your point, it's actually the least populated state. There's only
Okay.
500,000 people in the entire state of Wyoming,
Yeah, I
which,
knew I knew it was down there, but I
yeah,
didn't know if it was quite the
yeah.
bottom.
Yep. But just and there's just all these variables around it, right? Like you've got Front Range of Colorado north of Denver that's gotten really hot and appreciated a ton. You've got Salt Lake City, Park City, that area, and now up in Montana too. You've seen a lot of growth. So all the variables around it have been growing. And but I mean to specifically answer your question, just growing up there and knowing the markets. Like the first easy one that I did was, and it's still one of my best ones today, is Laramie, Wyoming. Laramie is a smaller town, but it's a college town. There's always demand. I've never had any vacancy, like literally like 0%. Like I have students move out the end of July, and then they're like on top of each other moving in on August
Yeah.
1st, right? There's so much demand. And then I just started seeing that as I grew. So I started there, and then I did Cheyenne, and then I did like the town Sheridan where I grew up, and I just started kind of picking these other bigger towns that still had people moving there, had demand. And now we even do the little small towns. But when I'm underwriting a deal, I'm just a little bit more conservative in a small town, knowing I'm going to have less buyers. But at the end of the day, whether you're fixing and flipping or renting, there's a price point that somebody will pay, and as long as you buy it deep enough, you could
Yeah.
still make money on it.
No, absolutely. Again, the again, it's that paradigm between price point and cash flow, right? It's as
Hmm.
long as the cash flow can support the underlying vig of what you're paying upfront to acquire the asset, it can make things pencil a little bit easier. But again, just you have to have people that are going to live there, right? At
Yeah.
the end of the day, you can say it's going to cash flow X, but until you get someone signing a lease and actually dropping their front, pulling up with the U-Haul, it's a little bit theoretical, if you will. So from from the perspective of that, now when you're focusing on again these kind of markets, it's a little bit easier again to use Houston or the Tampa Bay, Miami areas, large population centers. Typically the gravitas is towards your apartment, your multifamily, your larger conglomerated, high density unit structures like that. Now, when it comes to investing in these smaller markets, I'm assuming everywhere has apartments, right? But when it comes to these, I'm assuming that what you're looking for, especially when you're trying to package together more of a portfolio of assets, is it going out and finding multiple blocks of single family homes? Is it still the play on the dense population like apartment multifamily? Combination of both development, like what's that strategy kind of look like for you?
Yeah, I've built mine around. I guess it fundamentally it maybe comes back down to marketing, and I've just learned this from good marketing guys over the year. Like whoever can spend the most in marketing typically wins. So the way I've kind of equated that is when I go out and do marketing, meaning like I send out postcards, I send out letters, we do Facebook ads, Google ads, right? We put a lot of money in our website to bring traffic because our goal, for example, with WYO Houses, that's my direct to seller company, I want to be Wyoming's, and really are now, we're Wyoming's #1 home buyer. So now my goal several years ago was like, I want somebody to think, if I'm selling my house in Wyoming, I'm going to at least call WYO Houses first to get an offer and see if it makes sense. So because we cast all that net and bring all those leads in, my goal has always been, how do we monetize as many of those leads as we can, right? So I do for sure, like my bread and butter is some of these large multifamily ones lately. They've been kind of, I mean, those ones are awesome because especially when they're value add, because I can go put one crew on it. We've done this a couple times with like a 66 unit and a 45 unit where we go in and we bring a crew in there for like 9 months and they're just hammering away, living on site, knocking these out. And then I can go knock out 20 units at once versus 20 houses, to what kind of your point, that's a lot more work. But yep. So I do love those. But what my point I was making is I try to have a bunch of different tools in our tool belt to where when I get these leads, I can hold them as a big multifamily. I can flip them. Sometimes we'll just clean them up and relist them right away, or we can wholesale them to other people. But my goal is to be able to, I want to monetize as many leads as I can because that allows me to keep marketing and keep getting more deals.
Yeah. So, I mean, I guess you would say that it's fair to say that the way that you kind of found your niche for that, that you can't really do. I mean, you're Houston, you're competing with the BlackRocks, right? They're coming in and buying portfolios and all these things. You can't outmarket BlackRock, right? But going into a separate market, trying to find that competitive advantage. I mean, everyone needs 4 walls and a roof, right? Yep. That doesn't change whether you're in Houston, LA, Miami, or Wyoming. But again, that marketing advantage sounds like kind of one of those things that, maybe not a lot of other people have the ability to do, because more often than not, I mean, I would say, without going back to almost 200 episodes of this podcast, you're probably the first person I've talked to that's been in a, kind of focused on the low population, comparatively, centers, especially talking about Wyoming being the smallest of the 50 states, really to that. So how can you do that? Well, if you can capture all of a market, even if it's small, well, great, right? So what was kind of some of the first things? Obviously, you come in, college students are easy, right? They're going to come in, they need somewhere to stay for, 12 months at a time. It's a little bit easier to capture that. But when you start expanding on that, did you kind of start with the college and then say, hey, look, if we can market this and make us kind of the de facto people to go to, that's where we're going to find the value. How was that kind of transition into really realizing that the marketing aspect of this was so key and important in your success, especially operating in a market like Wyoming?
Yeah, one of the biggest things is our marketing just goes way farther than most other states. You were making that point about Houston and other markets. Like, for example, I'll give you they have what's called pay per lead, meaning some other company will go pay to get all these leads, right? They'll drive traffic to their website and then they'll sell them, right? And a lot of other investors like me don't, I don't know. It's a mixed bag. Some people love it, some people hate it. But for example, in Houston, you're paying like $250, maybe up to $500 for a lead that you're hoping to go close on and make 10 or 20,000 on, right? Versus that same comparative lead in Wyoming cost me like $75. So it just allows me to where like, okay, I can go miss on 10 or 20 of them even, but I can keep getting lots. So I've always been kind of cast a wide net, bring a bunch of leads in, and then have multiple exit strategies so we can kind of keep going whichever way. But at the end but the other point is too, so I mentioned that one, and when it comes to direct mail, right? These people, when they're not getting in Houston, I keep using that example, but I've talked to other guys that do what I do, and they go talk to a seller and they're negotiating, and the seller plops down a stack of postcards and letters on their table, be like, this is all the people who've been reaching out to me, right? So they're like constantly competing. So we don't have to compete against near as many people, but at the same time, we know, well, okay, so we don't have to compete against as many people. And then the second thing is we do a ton of construction. I've got like 5 different crews now that do our deals. So I can also quickly, like I can give this seller something that most other people can't, because I'm like, hey, I know what that's going to cost. And I know when my guys can start it. So I'm a little bit more predictable versus the typical wholesaler who's got it, who just is going to try to tie it up and go sell it to somebody else, and maybe can't estimate the rehab or even find contractors. Because again, it's a market that's really tight because there's not enough contractors. So that's really what's differentiated.
Sure. So is it then, as far as kind of like the acquisition, part of this equation, is it mainly that you're casting this broad net to bring in, is this more for the like single family side of the equation, or is this more for the multifamily?
Yeah, definitely. The marketing is more specific to the single family, but we'll just go pick a quick campaign and pull a list of multifamilies. And honestly, that's what one we want to do more of. There's just only so many in Wyoming, but those have been the biggest deals. So I wasn't like actively like, hey, I'm going to go do a bunch of marketing toward multifamily. We've just, because we're casting such a wide net and we're getting so much exposure, people are bringing it in. For example, a year ago, that was a little over a year ago, somebody brought me this. It actually was you know what? She got our postcard, and it was a 45 unit multifamily, and it was like a huge value add, like a home run of a deal that just came through our funnel. But again, just having a wide net, we're getting all sorts of deals.
Yeah, absolutely. So is the single family part of the equation more of the fix flip push out, or are you keeping that as part of like what you're packaging into your rental portfolios?
Yes, you bet. We all look at both of them. And that's one thing I meant to mention earlier when you're talking about price point, and there's a fine line between can you cash flow it. And another thing, again, comparing it to other markets, even the markets around Wyoming, like it's hard to still cash flow stuff in Denver, really hard in Salt Lake City, even in Montana it's becoming difficult. But we're buying it like our single family house prices, median is probably around 300,000, but I can still find them around 150 to 250. So if I find those ones, yeah, I love keeping those as rentals. But in general, the single family stuff right now, we're going to try to fix and flip that as much as we can. And then the multifamily stuff, that's when we're going to come in and raise capital through Bighorn Capital to bring in investors and hey, let's go take down another, like right now, we're taking down a 120 unit apartment deal in Evanston. And that's the one we're going to take down as a buy and hold.
Now, as far as that, I mean, just a quick aside, that specific deal, just for my own edification and the listeners as well, 120 units in a state like Wyoming, is that kind of the top of the sizing of the apartment complexes there? Do they get much bigger than that?
Yeah, it is. It's the biggest I'd seen, honestly. And it was at a town of, the crazy thing, it's a town of 10,000 people. And I was shocked when they first brought it to me. I'm like, there's 120 units in this little small town. So yeah, I haven't seen anything. I've got a 672 unit in Casper, but I haven't really seen anything bigger than 120.
Yeah, that's, I mean, just as far as that's almost like what 1% of the less than 1% of the entire town's population living in one place,
Yeah.
assuming three people per unit, maybe.
Yeah.
That's interesting. It's when you talk about the smaller markets, I always find it pretty interesting. Just having, I grew up in which not a small market anymore. Growing up in Tallahassee in North Florida, I mean, the whole panhandle of Florida is very. I mean, people think about Florida, they don't think about how rural parts of it get. I mean, the section from where I grew up all the way over to the border of Alabama is just, I mean, really, really pretty nice skies, no light pollution, but not a whole lot of people. And just thinking about how kind of the numbers for some of those smaller markets work. Now it's crazy how big it's gotten, but that's a story for another day. So, kind of looking at the operations of that. So you kind of have, again, two different avenues that you're looking at for kind of the investment trajectory that you're going out there. You have the single family stuff where you're casting the very broad net. And again, the bycatch of that being the multifamily stuff, which is more of the keep and cash flow stuff, but the turn and burn stuff being the single family. Now, as far as operationally, something that you mentioned before that I really like to dig into with people, especially in the real estate space when you're operating a little bit more at scale, is how much vertical integration you really try to keep and maintain with what you're doing. A big thing about real estate is that there's so many different things to do. A lot of stuff gets subbed out, farmed out. But where I really see people have a lot of success, especially in cost mitigation and just, being able to have a little bit more of a longer term ability to operate, is being able to integrate different aspects of it, whether it be from the construction side of things, whether it be, especially a big one right now I see in the multifamily space, is the ability to integrate property management into what you're doing as well. So when it came to this, where did you kind of see the writing on the wall, and how have you kind of grown into having that integration of different aspects of what you're doing in real estate, whether that be from the construction, whether that be from management, or other things that you've kind of put into your vertical of being able to do in-house and not have to farm out?
Yeah, I think it's kind of been organic, and I'm just maybe just being too much of a visionary. I'm like, man, we could do that. Why would we not do that? So the first one was property management, which I just was doing it myself and I was managing, but the kind of where it changed was I had 10 to 20 units that I was managing from Houston, and I had properties in Dallas, Fort Worth, and Wyoming. And it was actually when COVID hit, and we were all locked down, and actually we were worried about our jobs. Like we were laying off 40% of our company at Shell. So we had to all reapply for our jobs. So we're sitting around locked down. Everybody probably remembers where they're at that point in life. But we were in the house, all the kids, but I'm like, this is an opportunity because I just read another book, which has been really influential to me, which was 4 Hour Work Week. And in that book, he talks about like you using virtual assistants and just doing things more efficiently. So I'm like, wait, if I can manage these rental properties from Houston and I'm not there, why can I not train somebody in Mexico or Indonesia or Pakistan to do it? So that's what I did. I'm like, you know what? I'm going to build out. And again, I came from Shell. We're all about SOPs and written procedures. I'm like, I just wrote everything out, recorded myself doing these things, and built out a system. And now we were able to do it with like 2 to 3 virtual assistants. We've actually just got 2 right now, so we're probably going to bring on a third one. But we got 3 full-time virtual assistants overseas that manage 400 units. And I love it because all they do is they're doing all the processing, all the leasing. Like they'll do all they're doing everything obviously other than like swinging a hammer and doing repairs. And because I do construction, which is back to your original point of vertical integration, I've been doing fix and flips and deals for enough years that I've got a really good contractor network. So now we just have our list of people we call, and they're able to do all that back end management, right? Now, if it's an apartment building, like the 120 unit, we'll have somebody on site, right? But like all of our single family houses or duplexes or stuff that's kind of spread out, like we're able to do it with the property manager overseas, coordinates with, does all the marketing. And then a lot of times we'll do it like lock boxes, literally, or like digital lock boxes that we can change the code. And it's pretty crazy. But to your point of but go ahead, I'll let you go.
No, I was going to say, do you have any idea of what kind of what your price delta is for doing it in this form and fashion versus trying to do it in a more traditional way here? Because that's, and again, maybe you don't have the information. It's something I would definitely be interested to look into, but certainly, the utilization of VAs for all sorts of different stuff has been fascinating to watch over the past, 5, 6, 7 years, especially post-COVID when, a bunch of gas really got dumped on the fire for, the VA integration into a lot of stuff we're doing. And now we're seeing more, especially with the utilization of AI and different tools. It's really crazy. But do you have any idea of what kind of, price delta you're seeing on how much additional cash flow you can capture? Any idea on kind of what that might look like, versus whatever the, foregoing alternative for not being in this kind of structure and integration would be?
Yeah, I mean, I think in general, the rule of thumb, I mean, if you have more volume, you can negotiate better rates with your property manager. But I think you're typically paying, I would say, 5% at least to 10% is kind of a range for like long-term rentals. So if you just look at your cash flow, obviously you can pencil that pretty easy. But my cost, yeah, is significantly. I don't have the exact percentage, but off the top of my head, I bet I'm at with my teams, probably like 1% is my cost for them to run it. But it's also just, and this is where I was going to go too with your question, is like having the vertical integration, having the control, right? So for example, I'm taking over this new 120 unit. It blows my mind. These people are still working handwritten leases, and they still pay rent through cash or cashier's check or Zelle. And at least they're using Zelle, but no property management system. And it's just mind blowing, right? So, it's always a process to get them on board and moved in. But once they're moved in, we're able to we can now control the process. We can see when people are late. We can set KPIs on vacancy goals. But I just love it because if I was working with a third party, I would be always, and maybe that's your answer to your original question of why and how have you done it? I wanted to be able to, if I've got an issue or my vacancy isn't where I want it, or they're not pushing rents up to market rent, I want to be able to jump in and fix that quickly. And now because my team does it, and again, they're their own team, they have their own property, they have their own manager, right? But they meet every day, but it's really cool because if one of our KPI, maybe vacancy is not where we want it to be, I can jump in that meeting, ask questions, course correct really quickly, versus you're not going to get that same, you're not be able to influence a property manager that way.
Yeah, exactly. The velocity is really kind of key when it comes to, the operational aspect of it. I think people maybe put a little bit too much pressure on how fast things need to work, especially on the acquisition side. I mean, you need to be fast, but I was dealing with a client the other day, and it was a someone that really wasn't familiar with the commercial space that she was dealing with, and trying to explain closing timelines for commercial real estate for a single family, and they were getting bent out of shape on the fact that we were saying, hey, yeah, we'll close in 15 days pending inspection, all cash, and they were like, that's unreal. I'm like, you realize that most commercial real estate is at least 60-90 day close, right? So small anecdote, but yeah, just the understanding of how and where you really need to try to increase your velocity of action with this is another thing that takes a while to understand, and is something that I think people often overlook, right? They think, understand where you really need to kind of allocate your human capital resource of your time, which is one of the most valuable things we all have, because it is it is a progressive march. There's no way to kind of get any more back out of that fundamentally, right? I mean, you can
Yep.
kind of gamify the system a bit, but that's really interesting that is, really kind of what you identified. Now, to transition a little bit, still kind of keeping it within the integration sector, with regard to the acquisition, was the what kind of drew you into the construction portion of this, or the rehab portion of it? Is it something that you've always just been handy, or was it something that you kind of got the bug when you initially bought those first few properties and you're like, I'm not going to pay it, I'm just going to go swing the hammer myself? And how has that kind of grown over time? Is there aspects of the rehab and the construction portions of it that you have gotten away from, or is there stuff that you've mainly just kind of started continually added on to kind of what you're doing in that operational stack?
Yep. I really set the goal when I was starting to grow more rental properties, and it was just hard to find labor. So just in general, it was a problem I saw in the market where we couldn't find guys. They were slow, or they were doing multiple jobs, and they just weren't dependable, or their pricing was high. So I just was like, all right, as soon as I got enough rental units and enough fix and flips going, I want to pay a full-time guy that just works for me, right? So that was my first one, right? So I fired one like that, and then I hired second one and third one, to where at least I could support their salary, and then I just let those guys hire some like part-time guys to work for them. And then that's how I started to build out these crews, right? And then they could work on demand. But I mean, backing up just a little bit, I I was working with GCs up until then, right? And I mean, I still like, yeah, it's fun. I mean, that's one of the fun parts of the business, right? You get to see a property transform, and I did it all myself. Like from the very start, my first house, I did like a lot of other people, I did a house hack, did it all myself, got to see it. But then it's like, man, that's a lot of work, a lot of time. And the coolest part is when I started to be able, all right, now I'm going to have a GC do it, and I don't have to do it. I get to still see it come together. And then to get even better, now I've got like 3 crews that can jump in there, transform things. I get to go see it firsthand, or sometimes I'll just see the photos and see it transform. So I really do enjoy it. And the other thing I was going to say is, piggyback off of your last point about speed, when I'm talking to like sellers or looking at deals, right, being able to move fast in a fix and flip market, like obviously time is money. And most other fix and flippers that I'm competing with are, well, either A, they're just one person doing one job, but no one can like do it at scale and move quickly, because if you can fix and flip and get in and out fast and you can buy at a discount, to me, it's a complete game changer, right?
Mm-hmm.
But you can't do that unless you got crews and a schedule to maintain, because no one's ever going to schedule. And I mean, general contractors got to run their own business. So yeah, when I built it big enough that I could make my own schedule and schedule our own guys, it's been a complete game changer.
Gotcha. So, was there, with regard to kind of making that transition, what were some of the big kind of growing pains that happen with that? I mean, it's everyone's going to be different. Your experience, your mileage may vary for all of our listeners, but again, there's probably some specific points that you're going to say, hey, look, like if someone else was looking at is maybe in this position that's looking to scale or start to take on some of these things, some key points to look at that just say, hey, like, here's some things to watch out for. Here's some things that are some core competencies maybe that you really need to lock down and make sure you have a tight grasp on before making some of those transitions.
Absolutely. I mean, it was one I've kind of kicked back and forth for like a year, because the biggest thing is a lot of overhead, and you've got to have enough deal flow to keep these guys busy. right? Because you don't want to lose them. You don't want to be like, all right, I don't have any work for you for 2 weeks, because then all that time you built and all that trust, and like you could lose them, right? And I think that's why we've retained guys. If we keep them, they just go job to job to job, and they stay with us because they're busy. So the biggest thing is having that deal flow, and then the capital and just the overhead, those are all big things. Because I'm telling you, there have been points where I'm like, oh man, why don't I just work with a GC? Because then I can just pay him as he completes work, and I can just call him, and I don't have to worry about my burn rate or my overhead, you know. And the other thing is too, so I'd say that part, and the other one is just managing people, right? So now these guys do work for us. We got to incentivize them. We got to coach them. Versus the GC, if he doesn't get the job done, he doesn't get paid. So there are times I talk to other people, they're like, I don't have to deal with that. That guy if he doesn't do the job, he doesn't get paid. So those are balances that you kind of have to trade off. So you have to get, but if you can manage it right, then we try to get the best of both.
So would you say that really kind of the biggest aspect of kind of maintaining your own, crew, if you will, would really be deal flow, for making sure that you constantly are keeping them busy, right? I mean, it's like, an airplane doesn't make money unless it's, taking off and landing, right? So it's the same kind of analogy of that, to really kind of make that work, you really need to focus on the, deal flow that you have coming through to be able to make that kind of thing work. Otherwise, really the GC model of, saying, hey, like I got work for you, come in and do it. But I would imagine the big, downside to that, again, is kind of going back to velocity, is that, if you're dealing with the GCs, then, you got to be, it's like you're going to hope that they have the crews and that they have the bandwidth. They're not on 4 other projects and you're getting shuffled to the bottom of the list, right? Like, would those be kind of some of the big key factors that you would say of looking at this would be the key points for people to look at?
Yeah, 100%. Yeah, you got to have the deal flow. The only thing I would add to what you said is then the capital, right? The capital to keep funding deals. And that's another big thing I manage. And it's the reason why I've created Bighorn Capital, because I wanted to have, I didn't want to have to be like, all right, now we got all these deals, I got all these contractors, but how are we going to fund them, right? And it's just it's managing all those different variables. But yeah, if you could be well capitalized and have the crews, then those are the key things you got to have. But if you don't have, you got to have all 3, because if you don't have one of them, it's
it's a triangle, right? It doesn't stay up unless you have all 3 sides there.
Mm-hmm.
So to kind of again transition, I think that's a really good point to make, is capital, right? This whole thing doesn't work unless you start, feeding dollar bills into the machine. So, again, starting out with this to, quickly go back. I mean, again, it's your own personal money. I'm assuming you had money saved up from working at Shell, put a down payment in, cash out, refi, do another one. But that equation, comes to its, ultimate culmination quickly, right? You're not doing this at scale with things like that. So, and again, cash flow is great, but, these things aren't going to cash flow to that point to where you're basically just self-funding all this. So when it comes to, again, kind of your, transition, again, you're doing this, you're saying, hey, this all works well, but there, again, is going to be a transition from saying, hey, now we need to start bringing on, more or sizable capital in this. How do we kind of put this together to, make this attractive to people to say, hey, look, here's my vision, here's what we're doing, and ultimately what we're going to package together to make this an ideal scenario for an investor coming in. What are some of the kind of transitionary points to when was that point for you, and how did you kind of start making that transition? And then we'll get into kind of the the current ongoing and future trajectories of that as well.
You bet. Yeah, you hit on it really well as far as the refinancing, kind of bootstrapping it. But I think the first sort of transition was, at least I was able to build up some rentals that had some equity. So I would either go refinance, cash them out if I could, or what I started doing was I would go, if I had a deal where I had a good loan and a good rate. For example, I got one of my houses in Houston now, bought it several years ago and got like a 2.75% rate. So I owe like 400,000 on it, but it's worth like almost $1 million now, and it's a short-term rental and it cash flows really well. So what I've done is I would bring in a private money lender, and they would fund. Essentially, they're giving me a HELOC on a property like that, but I couldn't go like if it's your primary, you just go get it to the bank. But a lot of times, if it's an investment property, you can't do that, and you don't want to compromise that loan. So what I did is I started working with private money lenders, and I would secure them either in second position on a rental that was already cash flowing, or they would just go fund on a fix and flip. But the other big equation though is I tend to, if it's a fix and flip or like I don't use a ton of PMLs. I call them PMLs, private money lenders. I I typically put them in second position because it just works better for and it works better for them because I don't have a ton of guys right now. Well, actually, I'm getting more. But let's back up. When I first started, I didn't have a ton of guys writing me a $300,000 check to go fix and flip a property, or even 150. But I had people who could do 50,000, right? And what I would do is I would combine that with small banks. So I haven't talked about this at all, but I did this on that second deal I told you where I refinanced. I didn't go to JP Morgan Chase or Wells Fargo or Rocket Mortgage. I went to a small local bank and got to know them. And I've been doing that over and over all the years, getting to know these small banks in these small markets or credit unions and building those relationships to where now they could go fund on my fix and flips. And then I could combine that often where I would either put in my own money or I'd buy it at such a discount, or they would fund 75% and then the other 25 I could go use a private money lender to where I could still keep doing deals and be able to finance it, if that makes sense.
Yeah, absolutely. And I'm assuming again that kind of works well towards the scaling of a lot of single family stuff, right? But especially when you start getting into the multifamily stuff, your those zeros start to add up on that due to buyer line on that settlement statement, right? So when it comes to that, have you made kind of the jump into bringing in like sizable outside capital or structuring these to more of a kind of investment platform, like bringing in LPs or bringing in different people to kind of structure these and have these things again kind of bucketed for investors to come in and participate, or is that something you haven't really broached yet?
Yeah, absolutely. Um, and actually, one last one I wanted to make a point
Yeah.
on that last one because people might think, oh, you're just over leveraging. But typically, again, if I'm trying to fix and flip a house, I want to buy it at 70% of the appraised value, right? But the problem is when I go to a bank, even with these really good small relationships, they're going to give me a loan on like 75% of my cost. So even though I bought it at 70 cents on the dollar, they're only going to fund 75% of that. So therefore, I still want to be able to do, and I want to be able to finance all of it, and I want to be able to scale and be able to partner with other people. So essentially, we buy at a discount, and then we could have the bank finance a part, and then a PML part. And then I'll kind of roll into what you were saying. So that's how we've structured a lot of our fix and flip deals, and now now we're doing that more at scale through Bighorn Capital because I still love doing those ones. And I know our investors. I've got a lot of guys that have come up with me and done bigger deals that way because they get to be a specific investor on a specific deal and they have their own mortgage and their own promissory note. So it's really secure and really easy to understand, but very hard to scale, right? Hard to go because our goal is to do 100 deals this year. We'll probably fix and flip 50 properties, right? 50 different people on 50 different notes is a lot to manage. So
Yeah.
that's why we created Bighorn Capital Fund to where we have a couple offerings. We have like a debt fund where we pay between 10 to 12% on like actually getting to do that exact same strategy where we're lending to ourselves and doing fix and flips. And then I have more of my equity raise, which is doing more of the long-term buy and holds. It also does fund some of our fix and flips. It's a blend, but that's more for people that I have a lot of guys that now are looking for a longer outlook. They kind of look at it like I do, like, hey, I want to build up my assets. Let's hold this for 5 years, right? Let's get a little bit of cash flow and let's get the appreciation. Versus on the debt side, that's just a really easy in and out simple one for people to understand. And
No,
a good one for self-directed IRAs.
no, absolutely. Now, again, I always like to kind of focus on those transitionary periods because I feel like a lot of people, I think that's where a lot of missing information is, especially in the podcast, the education space, is people. You hear like the sound bites is like, oh, here's what we do. This is awesome. But again, it's that, you have to get there somehow, right? It's like, hey, it's, it was just, traveling with my wife and it was like, Google Maps in Japan was like, walk across the train tracks. I'm like, no, like go down a street, take a left, take a right, and you'll get to your destination. Like it's missing that big chunk of where I'm trying to get to right now.
Mm-hmm.
And that's important if you don't want to get hit by a train. So, kind of looking at that from the initial model where you're going out and, I'm a big proponent of that too, of the, smaller financial institution utilization, leveraging those kind of relationships because, as fun as the numbers are to kind of say on the Advanta IRA side that, hey, we manage, $3.7 billion worth of capital, right now for our clients, which is a huge number. But proportionally in what we do, we're still a smaller outfit, right? So I've been a big proponent of utilizing the, smaller, more nimble and people you can actually sit and talk to, people, because I think a lot of times people often overlook, they're like, hey, I went to the JP Morgan, I went to the Chase Manhattan, I went to the Wells Fargo, and you're no one to them. But your local credit unions, your local banks, they're all over the place, right? You can go in and talk to a banker, talk to a mortgage officer, and develop those relationships to where you can get the pricing of the capital, which is nice from banks, because you go to your private money lenders, you're gonna pay for their flexibility.
Hmm.
You're gonna pay for it, and again, not to say that that's not a bad thing. There's that's certainly if the deal works, but it's going to be more expensive. But being able to
Yep.
leverage those, I think, is a real important detail. But again, that transition from saying, hey, look, we're self-funding, we're going to these small banks, we're bringing in people, but you said it very well. It's like, hey, like, it gets to be a lot when you do 5 of those, maybe 10 of those, easy enough to manage. You do 50, you do 100, that's where you're like, all right, we need to kind of transition. So let's maybe talk about kind of like the first way, the first one. Was it initially setting up a debt fund? Was it initially setting up the more equity side of things? Did you do it all at once? And kind of how did that process go, and the like? Let's kind of explore that aspect a little bit.
You bet. Because yeah, it was a total evolution. I remember when I was actually first raising my big equity fund because I'm like, I decided I'm going to start a fund. I'm going to be able to, I got to have a better vehicle to scale this. So I went and I actually started, I had actually a big multifamily deal. This one I mentioned in Casper, which is 72 units. And I was actually presenting it. I'm like, hey, we're going to buy this one. We're going to buy some other similar buy and holds, but it's going to be like a 5-year buy and hold. And I was kind of putting this together and presenting it, but I still found that I hadn't done a larger, bigger deal like that. And I hadn't done anything long term. So everybody was really interested, but I was like, it was coming down to the wire and I had to raise the money. So ended up actually finding a partner who actually co-signed on the loan with me, and we didn't do it through the fund. But what I learned was, like we went and crushed it on that one, and that's actually been one of our best assets. So I did a really good job of like documenting that and saying, hey, here's this deal, and I got all these. I created my investor CRM, right, so I could stay in touch with these people who didn't end up doing that deal. And what I did was I did that deal with that other partner, got that exposure, got that experience, but then I kept finding more people, and it's just always been really natural and just a good evolution for people to come in, be a private money lender, have flexible terms, right? Like maybe put in 50,000 for 3 months or 6 months at like 10 or 12%. Because I was finding that there was a lot of people interested in doing that. And it's just a way for them to kind of dip in their toe. So what I found was really effective was to get people in like that, go do a couple deals. And then once they start doing a couple deals, they get their return back, they see how we communicate, they see how we run our capital raising. Then those are the people that naturally started to transfer into my fund. So anyway, my fund didn't take down that first deal. I did it with a partner, but we kept growing it. And then a year later, that's when we had our second big offering, which is basically now all those same people that I've been working with kind of getting their feet wet when I had that second offering. And we also had that first offering we could point back to. That's when really Bighorn Capital was funded and we really got lift, right? Because then we're like, all right, we got a deal. So yeah, that one actually we took down about a year ago, and it's been performing really well.
Yeah, and I think that's especially from the perspective of that I really do kind of like that, because again, everyone has to get their start somewhere, right? You don't pop out of the womb with saying, hey, look, I'm going to be an extremely effective multifamily operator, right?
Hmm.
It's a process, right? And being able to have that kind of experience of something that didn't necessarily, when I say didn't work, I mean just didn't work from the concept of like it didn't come to fruition of like a like multiple investor like kind of subscribed offering, right? It didn't come together like that. It came together externally, and you got the experience of saying, hey, look, okay, we got this other partner. Here's how it worked. This is actually working really well. Now being able to have done that externally as opposed to kind of trying to do that with a bunch of people's capital, I think is something to be looked at, especially from the lens of if you're investing your own capital, especially with a and when I say newer operator, I just mean from the fact of this particular structure, right? Someone being one of the first ones that are structured in this manner is really important, right? Because the big thing that any investor needs to look at is track record and experience, right? and having those things that really kind of lead up to a solid base, especially in this market with how many issues there are with so many things in the market, is really important. So I think that's kind of interesting. I don't think I've really talked to anyone that's like, hey, we were about to do it but didn't, and then we did our next one. I think that's something that's to be to be really uh, valued in this scenario. So again, that first one didn't kind of come together with the structure right. Still was a great deal. Still came together. Closed it, took it down. Now, when it came to actually kind of packaging it together, right now you're kind of again, you've had that experience with being an operator of rehabs in this business, but it's a different business, right? When you're coming in and managing a pooled investment of people, whether that be as a general partner or a manager of an LLC that's taking on outside capital, there's definitely some things to consider. Trying to sometimes it can be like herding cats, especially with dealing with investors. So, what were some of the learning steps that when you did initially kind of launch Bighorn and had that first deal come across and actually package it together in this kind of the context that we're talking about, what are some things that you really learned or were kind of big eye openers for you with doing that? Or was it a pretty natural progression? I'm assuming everyone learned something, but maybe kind of touch on that a bit.
You bet. Yeah, I think the biggest thing we learned was the when I did the next big one, I kept it simple with debt because I think if that's debt is the easiest people to understand. Because I was actually looking at it again, I was looking at some waterfalls and like an equity split and preferred returns. And then I was like, you know what? This deal is good enough. I could pay 15%. So I just did it as the second. We raised 1.7 million for this multifamily value add that we've got a good clear path to be able to refinance and pay everybody back. So we raised it at 15%, and we just made it simple and easy. And then we went and raised that 1.7, and that was just a really easy for people to understand. And again, it just kind of kept giving us the momentum, right? We had done the one multifamily. This was our second one, right? And so that was kind of step one. And then the next one we launched, which I launched about at the beginning of this year, was an equity one. We're like, okay, now we've done the debt ones. We can show the bigger, larger multifamilies. Now let's go out and do the equity one. And again, but I just kept talking to those people, right? Is like, hey, we're looking for somebody who's looking a little bit longer term. And yeah, and as far as like, we got the reps though. And here's the other thing from like the bookkeeping and the management to which you were getting at is like managing a fund. It's a lot easier to manage just debt because your money comes in, you make this interest rate, and it's pretty straightforward. Versus equity, there's a lot more to it. So that's kind of how we evolved and nailed that one down. Now we're doing the equity part.
Now, with the equity portion of it, kind of going back to a key of kind of a focus of this conversation being integration. So, did you with this structure with the equity part? I'm assuming this is pertaining to a specific property, right? A multifamily commercial use apartment complex.
Yeah, we actually did our equity one. We actually took down this 29 unit multifamily, but I wanted to have kind of a mixed use for a couple of reasons, right? So we do some fix and flips and we've got some buy and holds. And the reason is I wanted to be able to, like, again, it's like, I just want to continue, like, I would rather over deliver on our returns. And by doing the fix and flips, that allows us to actually have higher distributions, right? Because we bring in the fix and flips, we close those out. That helps us distribute it more and give more cash flow like now, right? But we've also worked in these longer multifamily ones that are going to have lower long-term appreciation. We're also doing some value add, but typically you wouldn't see cash flow on that until like year 2, year 3, or even at the end of 5 years, right? So that's why I like kind of blending it. And then the second piece was when I'm fixing and flipping, and I can't believe I didn't mention this yet, but I've always learned 2 exit strategies, right? And I always want to know, can I hold this as a rental? So when I'm looking at a lot of fix and flips, fix and flipping, again, can be one of the more riskier parts of the business, but we mitigate that through, hey, if things don't go well, if we miss on the rehab estimate, if we open a wall and don't see this coming, or if the market softens, right? Right now we're seeing a little bit of softness in the market. If we see all that, we can hold it as a rental. And that's why I love doing it within my fund, because I've got people who've got a longer horizon, right? We're not looking this because we've got to fix and flip it in 3 months. That's great. Well, if we do that, we'll make more distributions. But I want to work with people that are like, hey, if that doesn't work, we can hold this thing because, as we know, if you buy and hold, if you find deals at a discount and play the real estate game over time, you should always win.
Yeah, exactly. I mean, it's there's very few asset classes where you can almost say unequivocally that time will be your friend with real estate. Um, you know, maybe if you're building something on a hillside in California or right on the beach in Florida, depending on what's happening, you might see some issues with that. But again, historically speaking, again, it's numbers are numbers, and numbers don't really lie too much. Hold it long enough, and you will see that appreciation curve, and you will be in the black with it. But again, how long does that take? That's to be determined, right? And buying with the expectation that to be able to hold it and not be forced into a liquidation, I think is really important, and something that I feel is getting brought back into the market, especially with the softening of the market, depending on where you're at. Like, markets are softening pretty well in Florida and other places, and people that were kind of betting on that that roller coaster never cresting the other side of the hill are starting to see a little bit of some issues with maybe how they pencil their deals. But again, always having that aspect of being able to hold something, I think, is really important in whenever someone's investing in real estate. You can make a lot of money on investing strictly for spec and flip, but if you're investing only for that avenue, you're leaving yourself open to get burned pretty bad. If you're in a position where you're saying, hey, now we have to sell this, right? And you can always say, hey, I have to sell it, but maybe only be in a position where you say, hey, I want to sell this, not I have to sell this, right? I
Yeah.
think it's kind of a good lens to look at it. The last thing, we got a little sidetracked on that. Great points to make. But when it came to, again, one of the things that I really am enjoying right now is looking at people that are focused on integrations, especially with their operational stuff. Operational guy at heart. I started my career in operations, got into education and sales, but I'm always a big lover of everything operational. Is the the aspects of management, right? So especially getting into the multifamily space, are you integrating your actual property management with the fund that you're operating, or is that something that you farm out? I know you've been doing everything with the rehabs, but are you doing the actual boots on the ground property management, like the physical part, not the VA part, but the physical part? Are you actually keeping that in house as well?
Yeah. So the way it works is the virtual assistants have their dedicated person. And okay, if it's like, for example, if I have a rental in a random small town where the deal's numbers made sense, yeah, I'll just go find that local handyman and that'll be their call. But on the majority of our markets, that's where we try to buy and hold stuff, is where I've already got a crew there. And then it's just a balance of like, hey, does that guy spin off one of his guys for a day and they go knock out the repairs and maintenance? But typically, yeah, they integrate and work directly with my contractors, which again, and again, a huge savings, because your typical handyman is going to charge you by the hour, right? And he's going to have a minimum, versus I can send my guy over there and take care of something and might cost me 20 or $30 for it, versus having to go pay that guy.
Yeah, and I think that's also kind of an interesting aspect of how more fluid you can be in a smaller market, right? What you're doing with having these people on hand. If you're trying to operate in a market like, again, Miami, Atlanta, some other places, maybe that doesn't necessarily work as well, and you need to have either more people or just change it a little bit to be able to actually take on all that stuff. But when you're operating in more flexible markets like a Wyoming, or again your secondary or tertiary markets, and you can find that competitive advantage, you can be a lot more flexible and be able to create these other efficiencies where other markets wouldn't allow for it. And that's one thing I think from our conversation today, that I would say, if someone's going to take something away from it, besides the general fun story that we've been able to talk about, is don't necessarily overlook places just because they aren't getting the press that your local market or markets that get all the press get, right? Everyone talks about Atlanta, everyone talks about Houston, everyone talks about Miami, Tampa, LA, all these places, but people don't just live in these places. There's 50 states for a reason. There's people that live in all of them, and being able to kind of find the efficiencies where they lie can open up a lot of doors, where otherwise other markets may not necessarily offer it to you.
Oh
So
yeah.
Um, kind of to kind of bring this in a little bit for a landing, from, what you've learned and how you've kind of developed this, where do you see, your path going forward with this? Is it, any things that you're looking to try out anew coming forward, or is it, again, doubling down on certain things, or, where do you kind of see yourself going with the strategy going forward?
You bet. Yeah, I think we're just trying to continue to scale what we've gotten really good at, which is finding good deals, fixing them up, and either selling them or holding them long term. And then now the bigger part is now raising more capital. But I've just kind of thought as I kind of built out all these vertically integrated companies, I found, hold on just a second. Sorry, the kids are coming in, but
Yeah.
okay, I'll just keep going. But what I found was as I built out the vertically integrated companies, like it was fun and I enjoyed doing that. But I don't know, I just have enjoyed working with people and helping people along the way. And working in oil and gas, working with a lot of my colleagues, I know they didn't have the time to do what I did, or didn't maybe have the desire. Maybe instead of maybe on their 2 weeks, they actually wanted to go on vacation or have fun and not go flip a house. But I still wanted to work and help those guys and give them what I now have. Like I ultimately left my W-2 job because I wanted to be able to do this full time and be able to do like what I'm doing this week when I'm in Florida with my kids at a baseball tournament, but still getting to work in like my work life. So my goal now is to help more people achieve that same financial freedom. So that's what I'm mostly focused on now is actually like, how do I actually help these people, right? How can they either help them go find their first deal, or if they want to be passive on one of our deals, like just giving those people those opportunities, but more so just training and educating them, right? Because I learned it all through the years and getting reps. I was listening to books on Audible, listening to podcasts, like I'm sure a lot of your listeners do, but then I also want to like get them into a deal, get them some exposure, whether they want to be completely passive or active, but like just get them some reps. So that's what I've been leaning into the mostly lately.
Awesome, great. Well, again, I really do appreciate your time today. I said it before, and I have my corny little sign off that I always do, but it's true. That's why I say it. The most valuable asset we all have is our time, because no matter how great we invested or all the different things we do, can't make any more of it, right? You don't know how much you have of it in your entire life, and you do have a finite amount of it. So treat it as a scarce resource, and value it, and try to make the most of it. And I do appreciate you taking an hour out of your valuable day, especially but looks like you're down there, on a vacation of sorts with your family, to come and talk to us. So, if people are interested in reaching out and learning more about what kind of deals you have going on or want to connect with you, what's the best way for them to touch base with you?
You bet. Our website's really easy, CaseyGregersen.com. But also, whatever social media you guys are on, if you're on Facebook, Instagram, YouTube, go check me out. It's really easy to spell my name, Casey Gregersen, and you'll find me on all those. And I'm really like, I love sharing the things I do from my family life to working and doing deals. So I'm like, I share it all. So I'd love to connect with you guys on that.
Fantastic. Well, again, really appreciate you being on with us today. Really appreciate everyone listening today. Again, this has been another edition of the Alternative Investing Advantage podcast. Thanks for joining, and we'll see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.